Inventory valuation is the inventory accounting process that has responsibility for assigning a value to a company's inventory. This is typically managed by a department within accounting that focuses all its efforts on inventory accounting. The main job of this inventory accounting function is to keep the value of inventory recorded and current. This is generally done one of two ways. The first being a periodic or yearly interval where inventory is recorded at fixed intervals, and the second being a perpetual method. Perpetual methods update inventory in real time, which tends to keep a more accurate recording of inventory on hand. Without a current understanding of inventory on hand, it would be impossible to control the overall dollar value of inventory. One more thing to note is that both periodic and perpetual recordings use the most common forms of valuation: FIFO, LIFO, and average cost of inventory. We will learn more about these two types of recording methods in later videos. For now, let's turn our attention back to valuation and understand why an organization needs to establish a valuation to control and manage inventory. The way a company does its inventory valuation directly impacts its cost of goods sold, gross income, and the monetary value of inventory that is sitting in the company. With this in mind, inventory valuation affects the profitability of a company and its potential value, as presented in its financial statements. This brings us to another reason why valuation must be established. Inventory has a value, and that value is shown on a balance sheet under assets and on an income statement under cost of goods sold. These two financial statements are very good indicators of how a company is performing and where it stands in terms of financial health. In addition to these financial statements, inventory valuation can be used in analysis of inventory turns, as well as when an organization needs to make decisions with regards to building up inventory by investing or drawing it down. Selecting an inventory valuation method is also a very strategic decision because once a company has made its decision, that decision is generally a binding one. The IRS requires companies to commit to one method during their first year of filing taxes and to obtain permission if they want to change the method in subsequent years. This is why it is so important for these financial statements to conform to regular accounting standards. One tip to keep in mind is that while balance sheets and income statements show inventory in the form of raw materials, work in progress, and finished goods, they do not show MRO inventory. Also, it is very important that you talk with a reputable and licensed CPA. While Lean Strategies International LLC understands and is educated in valuation, a licensed CPA can give you the best advice on how your inventory valuation should be calculated. Now, you're probably wondering, what are the different types of inventory valuation? In the next few videos, we will introduce you to the following methods: actual costs, average costs, first in, first out, or FIFO, last in, first out, or LIFO, specific identification, standard costs or costing, and transfer pricing. We'll see you soon. Inventory valuation can make or break a company. It is absolutely essential that the valuation method you choose aligns with the needs of your specific business and the industry it serves. In this video, we will introduce one valuation type known as actual cost valuation. Let's dig in. Actual cost valuation is one of the most basic and frequently used types of valuation because it values inventory based on the actual cost of the item in your inventory. You may hear actual costing referred to as item or batch costing as well. Put very simply, actual costing is the actual cost of an item for all its movements through an organization. This includes, but is not limited to, when the item is sold and received, issued to the production floor, and moved. Actual costing borrows from FIFO by using the dates an item is received in. It then assigns a lot, batch, order, or serial number to each and every item that is received. This unique number travels with the receipt everywhere. This is where actual cost is different from FIFO. Actual cost uses the lot and serial numbers to track and differentiate the actual cost of items that are received on the same day. Ultimately, this enables you to track the actual cost of the items or batches that have a lot or serial number assigned to them. There are many benefits to this approach. One is that it improves the accuracy of both job and item costing and estimating. While you should speak with a professional accountant or a CPA, actual costing is preferred by many manufacturers whose inventory costs fluctuate between inventory purchases. Some examples might be job shops, make-to-order shops, or engineer-to-order manufacturers that often experience drastic changes in their raw material pricing. Let's look at an example of actual costing. K&K is a large pharmaceutical distribution warehouse. K&K tracks inventory as it is received into and out of the warehouse. Each week, K&K receives about 10 orders of a popular virus-fighting capsule. In the first week, the cost of the bottle is $100. These bottles are given a lot number of 1. In week 2, the vendor's pricing changes and the order cost inflates to $125 per bottle. This lot is received in and given a lot number of 2. In the third week, inflation goes down and the bottles again cost $100 per bottle. This order is received in and given a lot number of 3. K&K receives these in and places each of the orders into bins. They use a FIFO method so that the oldest order is used first. Now, let's say that the orders are sold for $500 a bottle without any regard for the cost of each lot. As you can see, the profit in week 1 and 3 will be higher than week 2. Since they use the oldest materials first and the first order is used, then the second, and finally the third, this would be difficult to track actual costs without a lot number. However, K&K wisely assigned lot numbers to the bottles, and so they are better able to control the inventory and track costs as well as profits per bottle. And that's it. Actual costing, or the ability to check the actual cost of an item for all of its movements. Now, before you go, I'd like to ask you a question. If you buy 2 lots of materials, the first at $500 and the second at $600 each, and each of them get labeled with different lot numbers, what is the actual cost of each of the lots of materials? Share your thoughts in the community, comments, or upcoming assignments. And remember to come back often and study frequently. We'll see you in the next lecture. Inventory valuation can make or break a company. It is absolutely essential that the valuation method you choose aligns with the needs of your specific business and the industry it serves. In this video, we will introduce one valuation type known as average cost valuation, and sometimes referred to as weighted average cost method. The average cost method is an inventory valuation method used in accounting to calculate the value of inventory. Put very simply, it is the cost of all inventory items summed and averaged. The figure is calculated by dividing the total cost of goods by the total number of goods over a specific accounting cycle. While you should speak with a professional accountant or a CPA to decide the best method of inventory valuation, the average cost method is easy to calculate and has many benefits. One benefit is that the average cost method assigns a value to both the cost of goods sold and the cost of goods still available over a defined period. The period is usually defined as monthly, quarterly, or yearly. The average cost method is one of the most straightforward ways to determine cost of goods sold over a specific period. Let's look at an example and understand how the average cost method works. While this may not be critical to inventory management, it will help you understand how inventory is valued when using an average cost method. On the screen, you will see a company that sells goods. This sales ledger shows our data for the first quarter of the year. As you can see, we first add up the total number of items, and then we add up the total cost of all the items. Next, you would divide the total costs by the total number of items, and this would give you the weighted average cost per item. Now let's imagine that this same company sells 50 units during the same accounting period. You would then calculate the cost of goods sold by multiplying the number of units sold by the average cost. Likewise, you could calculate the cost of goods still available by multiplying the number of items remaining by the average cost per item. The main benefit of the average cost method is its simplicity, especially for companies that deal with large volumes of very similar items. On the downside, results can vary greatly from actual costs if your inventory costs are not stable. And that's it, the average cost method of inventory valuation. Remember, you should always consult an attorney, professional accountant, or a reputable CPA before selecting your valuation method. We'll see you in the next lecture. Inventory valuation can make or break a company. It is absolutely essential that the valuation method you choose aligns with the needs of your specific business and the industry it serves. In this video, we will introduce one valuation type known as first in, first out valuation method, or FIFO for short. Let's jump in. First in, first out is a method used in accounting for the valuation of inventory. While you may think of the movement of physical inventory when you hear the phrase first in, first out, this is not always true in terms of inventory valuation at an aggregate accounting level. In fact, when looking at valuation using FIFO method, one must assume that the oldest inventory is used first. What does this mean exactly? Well, assets that are produced or acquired first are sold, used, or disposed of first. With that being said, there is no direct relationship between the movement of physical assets and the valuation other than the fact that accounting assumes the oldest is used first. When looking at FIFO from a tax perspective, the method assumes that inventory with the oldest costs are shown on an income statement under cost of goods sold first. Any other inventory that is left over is paired with the most recent purchase price or production cost. So, why would an organization use FIFO? Remember, always speak with your accountant or CPA before deciding on a valuation method. In most organizations, as inventory progresses to later stages of transformation and as finished goods are removed from inventory and sold, the costs associated with the item should be acknowledged as an expense. However, in the case of FIFO, it is assumed that the cost of the oldest inventory will be recognized first. This lowers the total value of your inventory. With this in mind, there are many advantages and disadvantages of the FIFO method. One advantage is that when inflation occurs or prices are rising, the FIFO method reduces the impact of inflation and understates the value of your inventory. Of course, this also means that if prices are falling or deflation is occurring, FIFO overstates the value of your inventory. This occurs because the cost of the oldest items in your inventory. For example, during inflation, the cost of purchasing newer inventory will be higher than the cost of older inventory. Another benefit is that FIFO is probably the most used form of valuation across the global environment. One of the last benefits of first in, first out valuation is that it is a good method for reducing obsolescence of inventory because the oldest is used first. Now let's turn our attention to the disadvantages of FIFO. To do this, we will quote from an article on Investopedia entitled, "What are the disadvantages of FIFO accounting method?" You can find a link in the article below. In the article, the author, Greg DiPersio, cites two key disadvantages. The first, according to the article, is that FIFO tends to overstate gross margin, particularly during periods of high inflation, which creates misleading financial statements. Costs seem lower than they actually are, and gains seem higher than they actually are. The second disadvantage, according to the article, is that because of these high profits, a company may incur substantially higher income taxes. Let's look at an example of FIFO before we go. Let's say we purchase 100 items for $5 each, and 100 more items are purchased next for $10 each. We now have 200 items with a total value of $1,500 in inventory. Now let's say we sell 20 items for $20 each. FIFO would assign the cost of the first 20 items resold at $5. Because we are using FIFO, the cost of the first 20 items is $5 each. This means our cost of goods sold is $100, and we have a remaining value of $1,400 in inventory. After 100 items are sold, the new cost of the item would become $10 regardless of any additional inventory purchases that are made. And that's it, FIFO. Now, let's make our minds think for a second with a little challenge. If we purchase 20 items at $5 each in month 1, then in month 2 we purchase 20 items at $7 each, and finally in month 3 we purchase 20 more items at $10 each, and we sell 15 items, what would the cost be under the FIFO method and why? We look forward to hearing your answers, and we'll see you in the next lecture. Inventory valuation can make or break a company. It is absolutely essential that the valuation method you choose aligns with the needs of your specific business and the industry it serves. In this video, we will introduce one valuation type known as last in, first out valuation method, or LIFO for short. Let's jump in. LIFO is a method used for cost flow assumption purposes in the cost of goods sold calculation. The LIFO method of inventory valuation assumes the cost of most recent products or last-in products of a company's inventory have been sold first. The costs paid for those recent products are the ones used in the calculation. In other words, LIFO is the opposite of FIFO. Much like FIFO, there is not necessarily a relationship with the actual physical movement of inventory and the accounting assumption. So, why would a company want to use LIFO? Remember, always speak with your accountant or CPA before deciding on a valuation method. They will give you the best advice for your specific needs. Sometimes the cost to produce or purchase goods increases. When these periods of inflation occur, LIFO may be a good option. While LIFO may make your products decrease on paper, this also means that you will not pay as much in taxes. With that being said, if the inflationary period is going to be a long one, it may be beneficial to reduce profits and pay less in taxes. Remember, we are not recommending what valuation method you should use. This should be done by a licensed accountant, CPA, or accounting attorney if they are qualified. Now, let's look at an example of LIFO to help us understand a little more about this method of valuation. Let's say we purchase 100 items for $5 each, and 100 more items are purchased next for $10 each. We now have 200 items with a total value of $1,500 in inventory. Now let's say we sell 20 items for $20 each. LIFO would assign the cost of the last 20 items resold at $10 each. Because we are using LIFO, the cost of the first 20 items is $10 each. And this means our cost of goods sold is $200 and we have a remaining value of $1,300 in inventory. After 100 items total were sold, the new cost of the item would become $5 only if no new items were purchased. One thing to note about LIFO is that it is only permitted in the United States under rules that are set by GAAP, or Generally Accepted Accounting Principles. And that's it, LIFO. Now let's make our minds think for a second with a little challenge. If we purchase 20 items at $15 each in month 1, then in month 2 we purchase 20 more items at $20 each, and finally in month 3 we purchase 20 more items at $25 each, and we sell 15 items. What would the cost be under the LIFO method and why? We look forward to hearing your answers, and we'll see you in the next lecture. Inventory valuation can make or break a company. It is absolutely essential that the valuation method you choose aligns with the needs of your specific business and the industry it serves. In this video, we will introduce one valuation type known as the specific identification method. Let's now answer the question, what is the specific identification method? The specific identification inventory valuation method is used to track each and every item in your inventory individually. This includes the time it enters the inventory until the time it leaves it. Let's not get confused here. Specific identification is different from LIFO and FIFO. LIFO and FIFO groups pieces of inventory together based on when they were purchased and how much they cost, while specific identification identifies and tracks every piece of inventory individually. The specific inventory method tags or marks each item with its purchase cost and any additional costs that are incurred in the transformation process until it is sold. So, what are some different reasons that a company might choose to use this method of valuation? Before we do that, we need to remind you to always speak with a CPA, professional accountant, or an accounting attorney. While we can share information on this method of valuation, they can give you the specifics that will fit your needs. Okay, the first reason a company may choose to use specific identification is because of the cost of the item. For example, you would not want to identify and track every move of low profit inventory. However, you may want to consider this method for larger and more expensive items. While many types of valuation are not directly linked to the physical movement or location of the inventory, specific identification is to a certain extent. For example, items that have different features may need to be identified in a specific way so that costs can be tracked and they can be pulled from inventory easily. The final reason we will share comes from Investopedia, and you can find the link in the description below. Quoting from the article, occasionally, it is used to identify specific securities. This method of identification allows investors to reduce or offset capital gains by picking a specific lot of securities to be used as the basis for a sale. One last thing to note about the specific identification is that this form of inventory valuation takes much more work to keep information organized and trackable. Now, let's look at an example before we go. Let's say you own a manufacturing plant. At your plant, you do assembly as well. Many of the parts look identical but require different methods of processing, which changes the cost. As such, each of your parts is tracked individually from the time they enter the lot until they are sold. In this scenario, the benefits are clear. The owner of the plant gets far more information about the unique parts and the different accessories and features that are most popular with his customers. As you can see, specific identification can be valuable in certain situations. Keep in mind, this is only an introduction to this method of valuation to better help you understand how it applies in inventory management. With that being said, we won't dig into specifics of this specific identification method just yet. But we would like to know, do you use specific identification? If so, what tips and tricks do you use to track items? Remember, answering these questions opens up discussion and helps build a community where you can interact with each other and find more solutions that ignite your power. See you in the next lecture. Let's begin by answering the question, what is standard costs or costing? Standard costs are actually estimates of the actual costs in a company's production process. These estimates are used because knowing the exact costs would be impossible until the process is performed. One of the benefits of using standard costs is so the company can quote, estimate, and budget more efficiently. Of course, using standard costs allows a company to see variance in the estimates once the actual data has been collected. As was mentioned already, no company can predict all the variables that will occur during manufacturing, so they use standard costs. Typically, as the actual costs are collected, a company should go back and check the estimates by entering the appropriate actual costs. If at the end of the accounting period the standard costs are higher than the actual expenses, then the company has a favorable variance. On the other hand, if the company's actual costs were higher, then the company would have an unfavorable variance. If the company's variance was unfavorable, the company must then analyze the data and find where in the manufacturing process the actual cost difference lies. Some areas they may analyze are labor, cost variances, material cost variances, and overhead cost variances. By doing this, it will reduce the variance in your estimates and help keep them more accurate. You may also hear standard costs referred to as preset costs, preset pricing, expected costs, predetermined costs, or preset costing. Now, you may be wondering, what are the advantages and disadvantages of standard costing? As a reminder, you should speak with a CPA, professional accountant, or accounting attorney before deciding on different methods of valuation. With that being said, there are many advantages of standard costing. The first being that it allows an organization to budget much better than without it. Next, standard costing plays a vital role in quoting items and assigning a value to the inventory that you have. Another benefit is that it makes it much easier and faster for an organization to produce financial records, and finally, it gives businesses a way to benchmark one another. With that in mind, every advantage has a disadvantage too. Some of the disadvantages of standard costing are: standard costing needs to be updated regularly. Without this, the estimates themselves will not assume any changes, and this can result in very unfavorable results. This leads us to another disadvantage, which is that standard costing really does not look enough on the favorable variances, but tends to be quite critical of unfavorable ones. Last but not least, standard costs require a lot of work to hone in and get your estimates accurate. With that being said, once they are accurate, they can be a powerful tool for a company. By now you may be wondering, how are standard costs calculated? Standard costs are calculated with three different pieces of data: direct labor, direct materials, and manufacturing or variable overhead. When these three elements are added together, you get a standard cost. One thing to note is that many people refer to manufacturing overhead or variable overhead as simply overhead. And that's it, standard costing. Now remember, this is only an introduction to standard costing, and we will revisit this topic later on. Well, thanks for watching, and we'll see you in the next video. Hi there, and welcome back. In this video, we will create a template so that you can easily calculate standard costs. If you haven't seen our other video on standard costing, be sure to check the description for a link to that video. Now, before we get started, we will be using Google Sheets to find and build our template and a sum formula. If you're not familiar with Google Sheets, you can visit another link in the description to learn more about this powerful tool. Okay, let's get started. Now, we've already got our sheet set up to number using a row formula, and we've frozen the top row to keep things organized when we are scrolling. As we learned in previous videos, there are three elements of standard costing: direct labor, direct materials, and manufacturing or variable overhead. With that in mind, we need to create some labels that contain the three elements of standard costs. Our first label will be direct labor, next, direct materials, and finally, manufacturing or variable overhead. The final label we will add is the label we will use for standard costs. Now, before we begin our standard cost formula, you may want to clean up your sheet a bit and organize it the way that you like. You may be using it a lot after this. Now, we're ready to start. As we learned in our previous standard cost video, we calculate standard costs by adding direct labor, direct materials, and variable or manufacturing overhead together. To do this, we will use a sum formula. Let's get started with an equal sign to begin our formula. Then we will type in SUM with an open bracket and highlight our cells containing direct labor, materials, and overhead. Then we'll close our bracket and you will see that a 0 pops up. Next, we will grab our completed formula, copy it, and highlight the entire column where standard costing is and paste the formula all the way down. Then replace your label on the top only, and now you have a simple template that you can input your direct labor, direct materials, and variable or manufacturing overhead in, and automatically calculate your standard costs. Remember, Google Sheets can be reformatted as currency, time, or just basic numbers, and many other ways too. So, if you want to reformat it, please feel free to. Also, this template is available by clicking on the link in the description, so you can build it if you want or save a little bit of time and visit our website. We hope you enjoy this easy standard costing template using a sum formula, and we'll see you in the next video. Though not a valuation method, transfer pricing is a technique that organizations use to assist in aggregate inventory management, especially when looking at and adjusting margins. Formally defined, transfer pricing is a practice used in accounting to transfer the cost of goods or services from one area of a business to another. This transfer could be different divisions, different segments, or even interplant transfers. While transfer pricing does not change the value of inventory, it can yield significant tax savings under commonly controlled companies. It should be noted that transfer pricing has very strict guidelines, and you should always consult a licensed accountant, CPA, or accounting attorney before engaging in transfer pricing. Put very simply, transfer pricing gives an organization the ability to transfer inventory between subsidiaries of a commonly controlled company or companies that are part of the same enterprise. This can lead to significant tax savings for corporations. While we won't dig into this topic, it is important for you to have a basic understanding of how this method works. Transfer pricing is a practice used in accounting that allows a company to price transactions internally within businesses and between subsidiaries. These different subsidiaries or divisions must be owned by the same larger controlling company. A transfer price is used to determine the cost to charge another division, subsidiary, or holding company for goods or services rendered. As you might have guessed, this tactic is mostly used to adjust profit margins, cost of goods sold, or assets that are still on hand. By doing this, a company can reduce profits or increase profits based on their specific needs. Typically, transfer prices are reflective of the going market for that good or service. Transfer pricing can also be used with intellectual property, and that's it. Transfer pricing. Thanks for watching this quick introduction to transfer pricing, and we'll see you in the next video.